With markets closely looking at Nvidia's post-earnings reaction and a pivotal day for the ASX ahead of Christmas, investors are bracing for a major reset in the global risk sentiment. And joining us today to outline more is David Scutt from StoneX. David, how is Nvidia trading? Take us through it.
G'day, Mike. Great to be back. Look, we've just had the release come out for Q3 earnings. Again, topped expectations and also guided well and truly above what the market was expecting for revenues in Q4. 65 billion being forecast against about 60 billion that was the markets were expecting. Right now, just looking at the screen, it's up about 3.5% in after-hours trade. The commentary about chip demand, Blackwell in particular, is saying the demand is off the charts. So at the moment, the share price reaction is probably not matching their spectacular earnings that we've just seen.
Okay, so how might Nvidia's performance today influence the broader US and global equity markets?
It's going to be important how it goes and trades into the next half an hour or so, because it's going to set the tone for what we see in Asia in particular. The tech sector is going to be watching these results very, very closely and looking at how Nvidia's share price reaction is going to be very influential, particularly on the likes of the South Korean Kospi and the Japanese Nikkei. So keep a very close eye on those markets because they're heavily linked to that tech sector in the United States.
So why have hopes for a Fed rate cut in December suddenly dropped, and what drove the shift? Take us through a bit about this.
Yeah, Mike, this was the big story before the Nvidia earnings came out. So there's been a couple of factors behind this. We're seeing a huge unwind in market pricing for a rate cut in December. So the first thing that happened was that the Bureau of Labor Statistics went, so that's basically the ABS version in the United States, said they're not going to go and release an October jobs report because they never collected the data. And they said that the November jobs report will be released on December the 16th, which is almost a week after the Fed's last meeting of the year. So what you're looking at on your screen right there, that's market pricing for a rate cut in December. At some stage, not too long ago, there was a risk of a 50 being priced in by the markets. Now it's down to just a paltry 7 basis points. So looking very unlikely at this stage that we'll see it further easing from the Fed this year.
Okay, so how is the change in Fed expectations impacting risk sentiment across equities and bonds as well?
Yeah, look, it's interesting to see how this is going to react with this Nvidia earnings report. But beforehand, the big move was going in the US dollar. We've seen some really big strength coming in there. It's actually closed above its 200-day moving average, which for the technical boffins is a really important level and suggests that we may be under a new regime change, a stronger US dollar. And that's absolutely pulverized the likes of Bitcoin. The Aussie dollar was down more than 0.5%. The Kiwi dollar was off more than 1%. And the Japanese yen has been taken to the woodshed and chopped up as well. So that stronger dollar story is weighing across a lot of different asset classes. Crude oil as well, down over 2% overnight.
So with all of that in mind, how's Bitcoin reacting to all of this and the changes we're seeing?
Bitcoin is not performing well in the slightest. I have to go and check the screens because it does go and trade quite in line with what we see with US tech futures. But beforehand, it was trading around about 88,000, which of course is very, very low, around the levels where it started the year. So keeping a very close eye on that. I still think it's a really important market for all investors and traders out there to watch, because I think it gives you a sense as to where directional risks lie for other riskier asset classes like stocks, like some of those currencies out there as well that are high beta plays on risk sentiment like the Aussie dollar. So keep a very close eye on what's going on in crypto markets.
David, you spoke briefly about the Japanese yen. Why should investors be perhaps paying closer attention to Japanese bond yields right now?
Yeah, Mike, this is not getting the attention that it deserves, and it really should. So what we're seeing in Japan, there's a diplomatic spat going on with China at the moment, which has been ongoing for decades, it's got to be said. But right now, there's been a clear escalation there. So that's an economic risk for Japan. And then at the same time, we've got the Japanese government talking about delivering unfunded stimulus in the form of fiscal stimulus. And so what we're seeing is Japanese bond yields, particularly longer dated yields out 10 years, starting to go and rip higher and actually going and hitting multi-decade highs in many tenors. Now, a lot of investors and traders will be like, well, who cares? You should care because this is the second biggest sovereign bond market in the world. And if the yields there start to go and drift high, it means that yields elsewhere will also likely start to go and move in that direction as well. You can see there across the screen there, particularly down the bottom, you've got 20, 30 and 40-year yields. They are really, really getting elevated now. And that's going to go and start pressuring risk assets the longer it continues. So keep a close eye on Japanese bonds out there if you're doing anything trading and investing right now.
Okay, so could movements in Japanese bonds create ripple effects for global interest rates or equities even?
It can, and it can definitely going to influence things like when we see US Treasury yields, which we know is very important for the housing market there. Probably not so much for Australia, but what it could do is pressure the Aussie dollar, because what we are seeing is the Japanese yen really starting to weaken as well. And the more that continues, the more it pressures other Asian currencies. So it's something that we should be watching as investors and traders. It's not just linked to Japan. It has global ripple effects, as you said.
David, how is the ASX performing if we turn our attention a little bit closer to home, and what does that tell us about market direction as we head very rapidly towards Christmas?
Yeah, Mike, this is the really interesting one as well for local investors. It hasn't really got the attention because we've been focusing on other things abroad, but the ASX has been absolutely hammered over recent days and has broken a string of really key technical levels as well. Now, a lot of that's on the back of weakness in the banks. We saw the CBA report last week. The markets didn't like that, and it's really led this decline coming through. And the thing that I'm watching today, SPY futures. Futures tend to go and drive the underlying share index. They went and closed beneath the 200-day moving average for the first time since earlier this year on Wednesday. Now today, they try to go and move back above that level, but it's been hit back lower again. So keep a very close eye on the price action today. It's not too much far-fetched to say that what happens today and the price action today could be really influential as to how we trade heading into year end.
Okay, and which sectors on the ASX are showing early signs of strength or even weakness as we approach that year end?
This latest downturn has really been led by the banks, obviously the biggest component within the index, and that's been the driving force. And then we don't have much of a buttress coming through from materials, which is the other side of the equation. Energy sector today, with the falling crude prices, is likely to go and be hit hard as well. The one silver lining to what's going on with the Aussie dollar is that it might actually go and support the local index today, particularly those offshore earners who earn a lot of revenues in US dollars in particular. So when you put that all together, you can see at the moment that blue line, that is the simple 200-day moving average. And you can see for long periods, the price has either bounced off it or been rejected. The fact that it's trading beneath it, the longer it sits there, the more likely it is it's likely to stay there for a prolonged period of time.
Okay, so how should traders perhaps and investors as well be positioning themselves given these cross-market developments that you've outlined for us today?
It's certainly an environment where you've got to be nimble. And it doesn't really matter whether you're trading Australian equities, or you're trading currencies or anything. Right now, it's quite skittish, and we have very elevated levels of volatility, particularly in the equity market relative to what we've seen in recent months. And what's going on with the bond market as well. If you are trying to go and make big bets at this point in time, unless you have a really strong conviction, make sure you keep risk management at the forefront of your thinking, because markets are very skittish in this environment. It's not basically a trend that we're seeing in one direction for any of these markets.
David, very well said by you. I want to thank you for joining us, and of course look forward to speaking again down the line.
Mike, great to be here. Take care.